Good morning once again. Hopefully you're not getting sick of my mug, but just want to continue to keep you up to speed with regards to some of the recent moves that we've been making. Um, Continuing to look for those phase transition signals. There is a tug of war that seems to be happening within the sphere of the economic sine curve, but that's not abnormal. And as that continues to happen, we just have to continue to identify how those signals are playing out. So, as it stands right now, it still is very much about the US dollar. If the dollar goes down, stocks, commodities, oil, gold all go up. If the dollar goes up, then because of the embedded inverse correlations to those asset classes and the dollar, those things will go down. So we saw that this morning. The dollar started going up on the open and then has since, at least so far, reversed. It's currently 11:35 on Thursday the 24th. So I'm going to just share a couple of quick screens with you so you can kind of see how this is currently being manifested in the market and what it's doing. So the first picture is a picture essentially of the U.S. dollar. This is a representation of the U.S. dollar as it trades in the open market day by day by utilizing an ETF symbol UUP. So it just shows the dollar index, which would be under DXY, continuing to move up. Now I'll tell you this: a move of this magnitude in a currency, basically 2% in a week, is really rare. That kind of move is just something that has a tendency to reverse itself, and it does so fairly quickly. The top end of the range, the mathematical range of the U.S. dollar today was 94.71 on DXY, and the dollar actually ended up hitting a high intraday of 94.65. And then it reversed. And so far, what we're seeing is a reverse of the US dollar. And so as that reverses, what ends up happening is a number of different things. The market as a whole, you can see, started out lower today because the dollar was higher. Dollar has reversed, has started going down, and so therefore US equity space is moving up. When we look at it through the lens of volatility, the VIX is still in what we call the chop bucket. And the current range of trade on VIX is about 24.5 to 30. And as it goes up to 30, then what that does is it gives us the opportunity to increase some exposure in some of the equity space. As it comes back down to 24, 25, we want to sell some of that equity space. Simply because the chop bucket has a tendency to be a very difficult environment for U.S. equities in general. The kinds of things that we wanted to stay in terms of U.S. equity space with VIX moving between 24 and 30 are those things that work on a tendency basis between quad 3, quad 4, stagflation, deflation. And so because of that, we've continued to basically look for trading opportunities within real estate, and you can see it's up about 1.25% today. Utilities up about 1.16% today. Of course, from there we've got the gold, which you can see started out a little bit down today, but that again is because the dollar was up. The dollar has so far since reversed, and so that's sending gold higher. The math suggests that gold could go anywhere up in the range of the 181 to 188 range. And the math, again, is a function of price, volume, volatility. And so when we look at volatility as represented by GVZ, you can see it's dropping. So a price going up with volatility coming down along with volume going up is extremely good. Volatility in gold below 24 is a good number. And so that's why over the last couple of days when we saw volatility spike but close below that 24, 23 level, why we wanted to gross up our gold position. And so we've gotten a pretty large position in gold. It is our current largest position. Second largest position is short-term treasuries. Third largest positions were long treasuries and extended duration treasuries. That's changing this morning because interest rates have gotten up towards the top end of the range. And as that happens, what it does with falling volatility in that asset class, the MOVE index, which controls the volatility of of the Treasury sphere has essentially collapsed. The volatility element has gotten squeezed out of that. When that happens, the trade range of extended duration and long-term treasuries really comes and gets tighter. So, for example, if we look at long-term treasuries as identified by symbol TLT, it literally has a trade range between 163 and 165. So it got up towards 165 this morning, and what did we do? We sold some treasuries because it made sense to come out of that, because the math was suggesting that there's a higher probability and a higher likelihood that we could see TLT come back down towards that 163 range. So we'll buy it back, and we'll just work on trading within that range to increase some trade gains as we are in that chop bucket of U.S. equities. Back to the U.S. equity picture again, as the VIX level continues to pull down some from that 30 level. Again, the top end of the mathematical range this morning on VIX was 30.15. It hit 30.45 this morning, and as you can see, continues to fall. As it does that, equity space in general will do well, but also equity space within the things that we like. We like gold because gold does well in both quad 3 and quad 4. It can do well even in the midst of a rising dollar. So therefore, we want to own gold. It would naturally be making some sense that we want to own gold miners. So gold miners are, of course, this morning moving up, currently up 2.4%. We grossed up our position in gold miners over the last day and a half, 2 days, as they started to come down, and we'll continue to hold on that. I think the math is suggesting right now that the upside on gold miners is all the way up to about 44. Whether or not we see that is a function of price volume volatility. If it got up towards 41-ish, I would probably start to take down the position slightly if we saw VIX move back down towards that 24 range. So you can see what we're doing. We're just focusing on the math of the market as a function of identifying volatility as it relates to overall general U.S. equities. VIXN, which is the NASDAQ volatility range, is north of 35. And that is a really difficult area in terms of being able to be gross long in technology. And you can see the largest technology names have been extremely volatile and have had some really difficult last couple of weeks, which we don't own. And we don't own it purposefully. So again, just quick synopsis is we grossed up our gold position in anticipation that we would see the U.S. dollar reverse. We're starting to see the U.S. dollar reverse, and as that comes back down, we could see the dollar fall all the way back down to approximately 92.5 on DXY. That would give about a good 2% move down on UUP. Some of you have a short position in the dollar. That would make money as the dollar drops. So that's good. As the dollar drops, we'll see more likely than not gold, commodities, and general equities do better as volatility starts to come back down. If volatility represented by VIX hits 24, I'm going to start to unwind some of the equity exposure that we have in GDX, rare earths, real estate, utilities, things of that nature, and probably take some profits on gold at that point too. I would anticipate that we would start to see some changes in interest rates again, driving TLT down or long-term treasuries down to a buyable position again. And so it's just kind of that tug of war between where we are in the economic sine curve and those asset classes that do better within each lens, and just taking advantage of them by buying some when they're low, selling some when they're high, and then just kind of maneuvering and repositioning in between those asset classes. So this game is a lot harder than what people on CNBC might lead you to believe. It's not about stocks all the time. In fact, everything but. As you know, we look at it from a global macro perspective. We're looking at currencies, rates, stocks, bonds, everything in between. And the objective is to do two things. First and foremost, help control and minimize volatility to the portfolio, minimize the downside as best as humanly possible. Take advantage of those scenarios that are extremely oversold within the lens of price volume volatility, and then allow those profits to generate and then take some off the top. So in the example of pruning and planting, it's plant, prune, repeat sort of scenario. So at any rate, if you have any questions, let me know. I'm not so sure that the U.S. equity market is as well positioned as what some people might think. We still are dealing with a tremendous difficult scenario within the unemployment sector. When you look at the unemployment numbers right now, it's just not a pretty picture. And we're in a situation where the unemployment benefits are, for many people, running out or being dramatically reduced. The PPP benefits have been essentially exhausted. It's a difficult spot, staring at 25% unemployment on a more permanent basis is it's just nothing short of unfathomable. But that's where we are. And so you're going to probably see some of those things manifest itself in, I think, what's happening within equity markets. Just this morning, the S&P, the NASDAQ, the Russell 2000, oil, all these things reverted back into bearish trend. Oil moving to bearish trend is a big one because that suggests the possibility of deflation. That's quad 4. And so we're a little bit north of 40% probability that we see a deflationary cycle in Q4. We're not there yet. We'll take it day by day. We'll play it play by play, and we'll make adjustments as needed. Again, focusing everything that we can on risk management as best as possible, at least until we shift out of quad 4, where then risk taking starts making more sense again. So, at any rate, if you have any questions, please let me know. Direct line 608-354-1977. Email Chris at careformywealth.com. Thanks so much. Hope you have another amazing day. God bless.